Hi everyone, a warm good morning to all of you. I'd like to thank each one of you for joining us this morning for the technical session titled Impact Investing Opportunities in Financial Inclusion at Crossroads. It is my pleasure to invite the esteemed panel for the session. The session is co-curated in partnership with Impact Investors Council, and the session shall be moderated by Ms. Richa Natarajan, partner Unitas Capital Empower, and the panelists include Mr. Gaurav Gupta, MD Ananya Finance for Inclusive Growth, Mr. Vineet Sukumar, MD Vivritti Capital, Mr. Saurabh Johari, Group Executive Director and CEO Caspian, Mr. Pranav Kumar, Director of Investment at Leapfrog Investments. We look forward to a very insightful discussion. With this, I would like to hand over the charge to you, Richa. Over to you, Richa.
Thanks, Priyank. Good morning, everyone. I guess good afternoon. It's nice to moderate this session with this, very exciting panel that we have. I know we have about an hour to 75 minutes to go through this. Before we jump right in, it might be nice if we can just hear a minute from each of our panelists, because I think we have a very, very diverse and vibrant one, a little bit on their backgrounds as well. And maybe Saurabh, if you can go first, followed by Gaurav, Vineet, and Pranav.
Thank you, Richa. Hi everyone. I'm Saurabh Johari. I'm Executive Director and CEO at Caspian Equity. I have worked on both equity side and earlier as CFO for the group of Caspian. So we do both equity and debt investments in the inclusion space, financial inclusion, agri-tech, renewable energy from Caspian. Before Caspian, I spent 7 years with Janab, small finance bank now, that time microfinance, and before that 12 years with Infosys. Thank you.
Hi everyone, this is Gaurav. I'm with Ananya Finance for Inclusive Growth. I'm part of the operating management here. So we are an NBFC and we've largely been a wholesale lender to MFIs, actually small MFIs mostly, say below 150, 200 crores in size in terms of AUM. We have been extending wholesale loans and building their capacities, and for the past 10, 11 years, we took over from our parent, Friends of Women's World Banking. And between our parent and us, we've had the opportunity to work with many small MFIs and see them scale up to become large, and some of them have even become banks today. So today we've also diversified into a retail model where we partner with these MFIs and we help them actually. We continue to build their capacities. We take up exclusive branches, convert them into model branches by automating them, introducing other products, etc. So we've grown to about 65,000 retail clients in the last 1 year. I've been with Ananya for about 8 years. Joined the company when it was just coming out of the AP crisis impact, and before this, I was with Citi, Standard Chartered. Also had a short stint of setting up a clean tech startup myself. Thanks.
Hi, I'm Vineet. I'm one of the founders of the Vivritti Group. We run a lending company, an asset management company, and a digital platform. Vivritti is focused on the enterprise finance problem, a problem that today spans close to 40,000 enterprises rated between unrated to a single A that have far more limited access to finance as compared to their counterparts that are AA's and AAA's. The scale of the problem is very large, so much so that companies that are unrated to BBB to single A today have a debt equity of 0.4 versus the larger market being at 2.5. That's the problem that we're setting out to solve. Today, we run a lending company, Vivritti Capital, that has today provided finance to more than 400 enterprises today across the country, lending across pretty much every state of the country. We run an asset management company that is at the forefront of bringing global capital into India performing credit. And we run a digital marketplace, which today has enabled finance to more than 1,500 enterprises in the last 4 years. Thank you.
Hi, everyone. My name is Pranav Kumar. I'm a Director of Investments at Leapfrog. Leapfrog is a global PE fund with impact at its core. We invest in emerging countries in Asia and Africa. India is our biggest market. And we are very sector specialists. So we primarily invest in financial services. Now we also invest in healthcare companies. We try our best to invest in both, which is one of the themes later, tech fin companies, financial services companies that are rapidly leveraging technology, as well as digital first companies that are innovating in financial services. Leapfrog has over $2 billion of LP capital. We are equity only, and I look forward to rest of the discussion today.
Thanks, everyone. Just my Sorry about that. Looks like a session without a technical glitch is not possible. So that was really on my end. But just quickly, as my background, I've spent the last 15 years across advisory, consulting, investment banking, and investing, most of it in the impact space. At Unitas, we've helped companies raise roughly over $3 billion in capital, most of it in inclusive finance, from investors in India and abroad. A couple of years ago, we started a lending business called UC Inclusive Credit, and now we're launching an equity fund called UC Empower. The most interesting and rewarding part of my career has really been working with founders and entrepreneurs and helping them strategize and grow their businesses through this journey. So maybe with that, I'll just jump right in. I'll start with what I would think is a pretty bold statement. And for the folks that have been in the inclusive finance space may or may not agree. I think inclusive finance in India has crossed a tipping point. Right? What started as purely impact investing has now become more mainstream. Would I like to be more mainstream? Certainly so. It started as a journey which was really focused on a very small and disruptive idea of empowering the micro, and now today has broadened so much so to include credit, insurance, savings, all through a plethora of channels, distribution. As Ramraj was saying a little while ago, over $6 billion have gone into this in the last 5 years, and at least $1 billion more this year. And all of this across not just microfinance, but fintech, insurtech, SME lending. Part of India called Bharat by many. And this pie has moved and broadened quite a bit. And our definition of financial inclusion has also changed. The undercurrents of what is more relevant, exciting, and in favor has also changed. So we've, moved quite rapidly across the spectrum of inclusive finance, across both SME and consumer lending. SME lending, which was really, $56 billion opportunity in 2017, and consumer, which was roughly about $86 billion, has grown rapidly and will it be at least fivefold of what it is today in the next 5 years. I think 3 things have changed this. 1, tech infrastructure. So the whole Jan Dhan, Aadhaar, mobile trinity started this movement, but a lot of the work that was done on India Stack in UPI certainly made a very big difference. And today we have several tech-led business models that are a reality. The question, however, still stays, is it fin first or tech first, or is it really an assisted model all the way? Second, creative solutions. The quality of founding teams today is nothing short of incredible. We're seeing extremely passionate and creative founders that are spending time to identify problems, but also devise solutions that work, and have the agility to pivot, which was so needed in the last 18 months. Third, consumer awareness and acceptance. The unserved and underserved segments in India are more aware and more accepting of tech led solutions today. The skepticism and hesitancy we saw when microfinance or SME lending was first launched is just not there. They're more aware, open, and perhaps a little bit more trusting than they were a decade ago. On the other side of this is the demand equation, and we've seen that both the investor and the lender base has also increased just as rapidly. The likes of SIDBI and IFC being the early backers of several institutions. To today, you see hedge funds and private equity investors, just as you're seeing Pranav on the table, but also more mainstream investors like your Falcon Edge and Norwest. They're all keen, excited, and investing in this impact space that we now call inclusive finance. To me, this is mainstreaming. This is what I've been hoping for a very long time. And we've crossed this tipping point. What does this mean? And honestly, is this exuberance only on my side or is it in the panel as well? So maybe let's dig a little bit deeper and understand the trends and challenges that all of us are seeing in this space today and learn a little bit more about disruptions each of us are excited about. So maybe with that, I'll start with Gaurav. I've spoken so much about technology and, I don't think it can be emphasized more than it has already. But it has played a really disruptive role in financial services overall. But do you feel that the touch and feel is still necessary? The brick and mortar model, is it something that's of the past and digital first is the way forward? Or is it really an assisted model? Would love to hear your thoughts on what you're seeing on the ground.
Yeah, I mean, there is no doubt about the fact that inclusive finance has become mainstream. There have been so many innovations in technology, and microfinance institutions have also adopted, technology in many ways. But that is still here to stay. That's largely because of two reasons. One, there are still a lot of small lenders, small borrowers who are in areas who are still excluded. They are still excluded from. They're still untouched, and they don't have access to mobile phones. Just once again. So these these borrowers, basically they are still. Just give me a second, please.
No problem, Gaurav. Take your time. Maybe if I can just ask, Vineet the same question, right? On what have you seen with the business models you've been working through and having sort of been in this ecosystem for a long time, what has been, the learnings you've seen on the ground?
So I think the learnings have been quite considerable. I think when I started off looking at the space in 2009-10, right, the overall spread of financial services itself was at a very different level from where it is today. 10-12 years back, I would argue that there was a very significant amount of new to credit, irrespective of the segment, right? If we take a segment like microfinance, we were scratching the bottom of the pyramid, and microfinance balance sheets still were showing 80 to 90% new to credit at that point of time, right? Except the state of Andhra, which for various reasons was crowded. And when we went to segments like SME finance, I remember when Vistar set up their business, right? It was absolutely pioneering at that time, right? Nobody had encountered the kind of segmentation that they were doing or the evaluation metrics that they were using, right? When SK started scaling up on commercial vehicle finance in the used space, right, the difference between the largest player being Shriram Transport and number two was staggering, right? Small institutions had simply not started coming up. Consumer finance, again, similar story, new to credit. Today, I would argue, and it might be controversial, that new to credit doesn't exist, right? Today, the question is more about choice. The question is more about companies competing on technology, on underwriting, on their superior service levels, on their ability to give money on tap, their ability to get directly interlinked with the point of purchase or the point of use of money. So right from very, very interesting models like BNPL going to right down to farmer levels of financing and enabling dairy payments, right, which is a tough problem from a technology perspective, right? We are seeing companies having to innovate much more, right? So gone are the days of fat profit margins. The need of the hour is now more about efficiency and building unit economics for lending models. We've also seen a lot of changes post COVID, post the pandemic, because many business models looked very exciting, simply on account of pricing power, right? But now with the kind of data we've seen on delinquency, restructuring, etc., it's been a sobering influence and has forced everyone to rethink about their underwriting models and customer segment. In summary, I think for financial inclusion, these are good times because there are more lenders competing for the last mile. The borrowers today have much more choice than what they had much earlier. The role of technology, and right from having a bank account to a digital footprint to a unique identity has really helped borrowers in being able to access more opportunities than ever before. So the borrower is having a good time. Conversely, the lender also can have a good time if they pay very close attention to unit economics, to credit, and to growth, right? But it's not as easy as it could have been, say, 10 years back or even 7-8 years back.
Yeah, thanks for that, Vinay. Go ahead, Gaurav.
Yeah. Thanks, Vijay. Thanks, Vinay. So, Vinay, new to credit, I think we still have new to credit. I mean, microfinance has been able to reach out to, we have something like roughly about 60 million unique borrowers, right? So we still have a large untapped segment. We still don't have, reach, internet infrastructure, etc., in many parts of the country. Yet. So I think, and if you see the statistics, I think in the last quarter, couple of quarters, actually new to credit has actually increased across MFIs. I think today 14%, as per the last Highmark report, 14% of the borrowers are new to credit. So from that perspective, there is no doubt that existing customers, those who are mature, especially fourth cycle and above, I think they are. If I'm a borrower, I have been repaying a loan to an MFI for 3 years now. I've attended more than maybe 30-40 center meetings, and I need a new loan. I know that I can repay on time. I have the capability, the intent. I don't really need to meet somebody. I would rather prefer a self-service model from application to closure. But I think there are still a lot of new borrowers. There are still a lot of people who remain excluded, and they have to be brought into the organized lending space. So these are a few thoughts on that.
Thanks, Gaurav. It's always nice to see two views, right, on new to credit here or not here completely. But maybe just switching a little bit, to what you're seeing in lending models today, right? We talked a lot about underwriting being digitized, sourcing being digitized. Are there aspects that you think could be digitized better than they are today?
Oh, yes. Basically, microfinance institutions underwriting is. They are doing. They have mobility applications for client onboarding where bureau checks, KYC verification, all that is integrated. But underwriting is still not happening the way digitally. So especially for existing customers, as I said, there is no need for MFIs can certainly adopt. They have a lot of data. They have access to a lot of data, and a lot of this data is coming with customer consent. So, MFIs will have to, build AI engines to get into rule-based underwriting so that the turnaround time is faster. There is a lot more that MFIs will have to do for existing customers, mature customers, to retain their best performing customers.
Thanks for that, Gaurav. Saurabh, Caspian has been in this space and really seen and evolved through this microfinance journey into, inclusive finance. As you look at the Caspian portfolio today, how is that distributed and what are you most excited about beyond microfinance?
Thanks for that question, Richa. And yeah, you are right. We have a long pedigree in microfinance and really saw the sector really starting up. And while there has been a very exciting time in terms of a sector which has become almost 1.5 lakh crores, but it has gone through its ups and downs. And I think but we will still say it's far from maturity. Actually, I will stay with Gaurav on that point because as the demand is still there, but supply side can go deeper. So while the opportunities continue in the sector, and at the same time, it sort of led to birth of many new sectors. So uh, since we have already penetrated these customers, you can move sideways to either food and agriculture, especially if you are looking at more upstream businesses, which are more farmer connects related businesses, because in some ways, through microfinance, you have started reaching to these communities already, and access to customers have been established. There are also some, of course, always very exciting SME financing, which I would say had a lot of promises. Still, there are some very exciting models which we are seeing, we are investing. At the same time, probably we could not have a standardized microfinance kind of model which is scaled up to that degree in the SME. But again, like I said, many sub models which are doing very well. Similarly, as you broaden further, there is agri financing, there is education finance. So, in a way, the inclusion space, I think, sort of have exploded. Some of it on the back of credit bureau being established, credit discipline being established, customers trying to understand credit a bit better, their linkages being established. But at the same time, we are very excited about agri sector, real agri sector, where we are launching a early stage fund, which would be an equity fund. We do feel very excited about renewable, which also is something when we look at our SME fund, which is the fourth fund, we are realizing that the two investments and a lot of pipeline by itself is just getting built in that, although it's a more broad-based SME, but very exciting opportunities coming there. So overall, an exciting time, but at the same, I would also warn on celebrating victory too early. I think while if you look backwards, I think all the graphs have been mostly up, other than, of course, the crises and the recent last 2 years. But if you look at the overall sectoral growth in many of the other sectors in the country, be it telecom, be it IT, be it real sectors, I think we should not stay put too quickly. I mean, this is a journey which still has a lot of steam left and a lot more exciting models coming up. So we are very excited to be in the right place at the right time.
Thanks, Saurabh. You brought up an interesting point, right? We're seeing a lot more happen in financial services, agri, education. Just it's exploding in many, many ways now. But maybe just moving to Pranav, when you think of financial services, is it still a standalone business and an exciting vertical by itself? Or do you really see more platforms coming up, that offer financial services as a function and really more as a hook to upsell or downsell other products, right? Classic case being in the agri sector. Several platforms have come up today. What they've realized is that if I can offer credit as a hook to the customer, but I really end up servicing the customer's needs all the way from inputs, perhaps till market linkages, and satisfy the entire value chain. It's a more exciting proposition. How do you see the sector evolve today?
Thanks, Richa. I think in financial services, and when I say financial services, I'm including credit and insurance both, and to a limited extent other services such as payments and asset management. But if you just, for ease of discussion, keep credit and insurance in your mind, I think since a very long time ago, financial services has always been, on one hand, distribution play. Distribution was the hard part. And on the other hand, credit in particular, and also insurance, are very meaty revenue pools. And therefore, anybody who had distribution always thought about monetizing through financial services. This is not new. And anybody who was a manufacturer always wanted to partner with people with distribution. That's why the concept of bank assurance exists, right? Insurance want all the bank partners, and that's why banks and NBFCs always want to start insurance companies. It is not new, and this has evolved over time. So I would say stage one was when folks with large branch-based distribution were trying to figure out, can we do financial services? And we have some experience with this. So for example, we partnered with Mahindra Insurance Brokers. The idea was to do insurance to basically monetize their distribution. Then the next phase was, in our view, telecom, which was this very large distribution got created during the telecom revolution. And then a lot of people thought about, and in some parts of the world, they have successfully executed businesses with partnership with mobile companies, financial services businesses with partnership with mobile companies. We have a couple of those invested in our portfolio. And then this most recent phase, right, when you have the digital platforms with enormous distribution, and the same question comes back, right? For those who are manufacturers, can we partner with these guys and access their distribution? And for these guys who have this enormous distribution, and many of them actually have built their distribution on some kind of, you can call it hook products, but they have not necessarily fully monetized it. And their thesis is also to monetize via financial services in the future, right? So this is just a new phase in a long history of this distributors and manufacturers trying to figure out how to do this. And in my view, therefore, there are lots of lessons to be learned from people who have already tried before in a different context. For example, one lesson a lot of people in the audience and panel probably agree that doing only captive hasn't really been the success marker. One of the biggest success stories is of our time in this theme is Bajaj Finance. But their market cap is not built of their monetizing financial services of their captive distribution. That's not how it played out, right? So that's something, and so therefore lots of lessons to be kind of gleaned from people who have tried it in some forms of shape in the past. One last point I'll make, right, especially on digital distribution. We actually recently invested in a company called Car Dekho, but mainly to back what they're doing in financial services, which is used car loans and also insurance Dekho. But essentially, there are lots of pros and cons. I mean, reasons to be excited about this thing, digital piece, because it's digital distribution. You can scale very fast. You can potentially have lower cost. You can have all the algos and etc. But on the other hand, there are also reasons to be skeptic. So there's, especially in the digital side, there's a lot of real genuine concern about how do you transition from a digital business model to a balance sheet model. Suddenly, if you don't generate cash, and then suddenly, to make an extreme example, a few years down the line, people want to value you price to book. That would be a disaster, right? So that navigation itself is not trivial, and it is a big stumbling block for people to follow that path. And similarly on DNA, and India is very blessed. Richard was saying India is very blessed with talent pool. So I do not believe that it can't be done. You can figure out right talent pool and create these businesses and get them going. However, there's a lot that goes. There's something to say about DNA and underwriting and collection and culture and SOPs and all the things that many people on this panel, especially entrepreneurs, Vineet, Gaurav, they put into place. It's not automatic, right? It's not so easy. So it's evolving. We are also watching. I think some will be able to create next Bajaj Finance's version of the digital world, but many will also stumble, and there will be a role for specialists to kind of do the specialist thing and partner with these platforms and basically work together. So that's, I guess, Richa, my best guess of where this might land.
Thanks for that, very interesting analogy as well, Gaurav, Pranav. I always wonder, right, when you're looking at such businesses, especially platform plays that are out there today, is the expertise that one has in lending and credit sort of paramount? Would you back a business or a founder which has the platform and the distribution that you talked about, but didn't have lending or credit expertise? Do you think it's wise to do that, or do you think there is sort of worldly sense that founders that have been through the lending cycles that they can actually put into these businesses today?
Yeah, no, it's a very good question, and that's why I was alluding to that it's fraught with risks. And as in the past, if you look at for example, all the car companies, right, or in the motor space, many of them have captives. And it cannot be said that all the captives have created enormous market cap. They have not. And the same will happen now. So the answer is a little bit boring answer, Richa. I think those, in my view at least, those who approach this very thoughtfully, respect the hard lessons learned by people in the lending business on importance of collection and you do scale your disbursement, but you give a lot of emphasis on seasoning and all the other things that go into having some touch, to your other question. So you have tech, but where do you introduce touch thoughtfully? So take that extra cost, but make your model much more resilient, etc. So what I'm trying to say is, either it is a grind, and some folks will be up for it, and there is deep talent in India to be able to build that. Or in other cases, folks may be better off partnering. And there are lots of very good fintech and financial services companies who will be great partners. And there is merit in considering both options very thoughtfully.
Thanks, Pranav. Saurabh, maybe just going back to your portfolio, right? Leveraging what Pranav has just said on, a tech plus fin mindset, right? And not isolating either one of those. There's a lot that the sector has been through, right? All the way from AP crisis to demon to IL&FS, and we can keep going on and on, right? Including the pandemic. Is there one company that stands out in your mind that has truly weathered the storm, either by pivoting their business model, staying true to what they were building, partnerships, what have you? As you look through your own underwriting algorithms, if you will, what has changed in this? We're not post-pandemic yet, but I'll say in this mid-pandemic era that we're in perhaps today. What has changed in your mind?
So in terms of companies, Richa, of course, there are many companies. Surprisingly, the companies in which work in the real sector have probably a lot more options. And if you watch some of them, the journey is a lot more just evolved because of the options they have, like can think of a company based out of Bangalore, which was making bio-based pesticides, and the product was successful, and they expanded very quickly to 10 states, dealer network, shortage of price, shortage of cash, uh, payment issues, went quickly into distress, facing difficulties in payments. And then I think with the help of some well-wishers, the technocrat entrepreneur realized that you have to understand in the early stages of the business, cash flows are the king, and then pulled back, increased focus on 3 states, deepened the dealer network, started another few lines of product, which like a biofertilizer, which was an adjacent product, and he has like 15 patents now. So revenue grew to by 75%, but gross profits increased by 100%, and company started making good on the payments again. So I think in the real sector, again and again, we have seen there are various options which entrepreneurs use. In the coming back to the financial institutions, I think the response to crisis is more cookie cutter, right? I mean, everybody knows that focus on your collections, look at your ALM to start with, decrease your OPEX, get capital from somewhere, right? I mean, these are the 4 steps, and depending on where all you are and on which sort of action you can do first, but that may change. But really, that's what we have seen again and again, company going back and doing in some forms of that. But when you come to the execution, of course, the journeys are different. For example, in education finance, there are interesting companies trying different models, sometimes schools, sometimes customers, and have been successful to some level. In case of microfinance, I think and because of the standardized metric, the underwriting has again got somewhat streamlined. So when the pandemic started, we had a contrary view on microfinance. We actually increased the debt portfolio allocation to microfinance, which earlier was around in the range of 10-12%, and we almost doubled that to 24%, because we understand the sector very well. And frankly speaking, about 5 years back, we had the view that sector is becoming somewhat frothy, but now with the multiple crises, the competition has come down. People have got saner, and really some of these leading matrices can help you in the underwriting reasonably well if you have certain view on the environment as well. And fortunately, in this latest crisis, one part which was very helpful was the regulatory action. And we had some confidence on that regulatory action. But having said so, not every institution has survived the crisis well. We do think that a recapitalization of the sector will be required. Definitely some institutions out there will need it, will need the capital. So yeah, the underwriting has to be tuned to these matrices and looked at more recent performance. And like I said, in financial institutions, and sometimes we feel that underwriting is actually easier because all of us understand the sectors so well because of standardization. But when you come to the real sector, it has to be a little bit more non-standardized case-to-base kind of basis.
Thanks, Saurav. Gaurav, you've seen this on ground with smaller lenders to some extent, right? Given where we are with the pandemic, and no one can tell for sure whether this third wave is upon us, will be upon us, or will not be at all. But what is the advice you can give them? And in the event there really is a third wave, do you think the sector in general is prepared for it? Do you think we've learned from the last two waves such that we know what's coming to us and how do you deal with it in advance? Changes you needed to make either in your underwriting or sourcing or distribution or collections has been done such that the impact will not be as grave, or do you think we're far from that?
I mean, basically, yeah, I mean, as Saurabh said, first of all, Saurabh, thank you for coming back to the sector, actually. So, yeah, so I think, I mean, the last 5 years has been just too eventful. I mean, much more than what we would have wanted. But the sector has only come back stronger. So, I mean, look at the number of people who have been reached out to under the microfinance. It's gone up by almost fivefold in the last 5 years. So from that perspective, I think the sector, if there is a third wave, I think the sector is prepared for it. See, we deal with mostly very small MFIs. So most of the part, and we have something like live relationships with about 50 MFIs across India. Most of these are very small, actually. But what we are seeing is that they are also reasonably well capitalized. They have taken hits. The stress is still, I mean, by stress, I mean PAR 90 plus rescheduled loans is still in the range of around 10%. Their tier 1 capital adequacy ratio is about 20-25%. There have been a few MFIs who have been able to raise capital in the last 2 years. They are better off with higher CAR ratios. They have been able to even write off and bring down their delinquencies. So, but what has also happened in these 2 years is the smaller players have been able to start relationships on two fronts. One is with public sector banks. They've been able to raise lower cost of funds thanks to the credit guarantee schemes and other stimulus packages of the government and the Reserve Bank. And B, there have been collaborations. I mean, we've never seen so many BC partnerships being started by larger NBFCs, even by some small finance banks. Now, these things have ensured that money continues to flow into the sector. Disbursements continue to happen. So we've seen the managed portfolio, the percentage of managed portfolio increase for almost every partner of ours. So I think if the third wave were to happen, what is extremely important is that MFIs go all out and raise equity. I mean, this is not the time to be finicky about valuations, about diluting stake. We are seeing that happen. I mean, there is consolidation also that is happening. So I think those MFIs that are able to raise capital, I think they will be able to survive the third wave. Those who are not able to raise equity, they will certainly find the going tough. It also depends. I mean, smaller players, they mostly have a high geographical concentration. So it also varies from geography to geography. But overall, I think the sector is prepared. Technologically, I think they are transforming. They continue to transform. That will continue to happen. I don't think that will, lead to MFIs closing down. It will be more about funding, more about equity.
Thanks for that, Gaurav. And it's a nice segue to, Vinny, Vivrithi has really been at the forefront of innovation, right, when it's come to products, not just in microfinance, but inclusive finance broadly. And, when Unitas at least started, we had started by only really seeing grants and moving up to guarantees and then moving up to plain vanilla debt structures and then equity. And now there's a whole host of instruments that's out there and many that you guys have pioneered. So maybe if you can talk a little bit about, these pools of capital that you've seen develop and come up over the years that you think are exciting for the inclusive finance sector as a whole, not necessarily microfinance, but financial services broadly. And what's been the uptake on that? Are you seeing enough capital really come into the country for it within or from outside? And are you seeing enough in terms of, these institutions that Gaurav was talking about actually being able to access and tap into those pools of capital?
So, Richa, I think in the last 12 odd years, starting from developing world markets, which came in 2011, and then moving on to many others who came in over the next, I would say 10, 12 years. What we have seen is the following. One, there is a certain role that pure impact investors play, which has definitely helped a lot of small NBFCs, microfinance companies scale up across the country, and the role that they have played in bringing these organizations to capital markets, cannot be underemphasized. It's been phenomenal. This is long-term capital, typically for 3 years or higher, very patient. We've seen many of these investors continue to stay with their portfolio companies through crises and continue to provide them capital as well. So their role has been phenomenal. Having said that, two limitations. One, we see far more flow of capital into equity than to debt. I would argue that India has reached a stage at which businesses have matured much more, right? There is a stage of life of a country where businesses should get more grant capital because the business model is not fleshed out very well and therefore needs support, and which could be support that does not really require a return or even a return of capital, right? Then there's a stage of life where growth looks exciting and equity capital starts coming in to make business models more robust, and then there's a stage at which scaling up is required, which needs debt, right? And I think India has been in the third phase for a while now. But I think when I look at the split of impact capital across equity and debt, we still see around 25-30% of debt and the balance being equity. And I think that has to radically change. What's become exciting in the last 4 or 5 years is the emergence of much more mainstream sources of capital globally, not necessarily India, but globally, that can support much larger companies, or even support the growth path of a company, both for equity and debt. Now, these pools of capital have significantly discovered India for equity. Again, not necessarily for debt, right? Because these are distinct pools of capital, right? Equity pools of capital today find India very, very exciting. And whether it is Japanese or the Americans or Europeans, or even Indian HNIs for that matter, right? Equity has been very exciting and there's been a lot of flow. Financial services has been very exciting because the largest number of exits happen in financial services, right? More than 40-50%, right? And therefore, the ability for investors to allocate more capital to FS is much easier, right? But look at debt, it's a very different story. When you go to a mainstream investor globally, then India private debt seems, for want of a better word, exotic, right? And therefore demanding much higher returns from these investors. The investors speak about 10% dollar returns for India, which is impossible given the issues around hedging and tax and so on, right? The number should more likely be 6 to 10%, right? A lot of our effort has been to try to educate investors on the fact that India's moment on debt has arrived, and as a result, risk is actually significantly lower than what might be indicated by our sovereign rating. For example, we ran a webinar around a couple of months ago that showed 20 years of history of asset-backed securitization in India, right? It gave a sense that although India's rating is capped at BBB minus, but India AAA actually performs equivalent to S&P single A or AA, right? So the evidence is actually overwhelming that the risk premium for India should be lower, and investors should actually find very, very good quality transactions in India with much more stable debt returns than they might find in many other parts of the globe. And as a result, that's been the messaging we put out, consistently over the last several years. I think the role of global markets cannot be overstated in mainstreaming any market, and we need to see more and more of that. Like I said, internationally, very encouraging. India still has to have its moment under the sun.
Thanks, Vineet. And I truly hope that moment is here, and we'll turn the corner soon, if not now, but shortly. I think we've come certainly a long way, right, from where it was 5-10 years ago to where we are today. Could it be sooner? Certainly, but I do hope, and maybe the eternal optimist in me says that we will turn that corner, and we have to do that through a lot of this messaging that we're doing. But as you said rightly, India for equity has just seems to be a very massive opportunity in the eyes of investors outside. And with everything that's happened in China, a lot of the capital has been flowing in here. with this, has the floodgates really opened? And it seems that way. There was so much pent up demand. A lot didn't happen in 2020 given the pandemic, and investors were holding back and waiting and watching, especially in the sector as underwriting was unfolding. But given where we are and the enormous capital flow that we're seeing today, do you think this is a short-term phenomena or a long-term one? And I request both, sort of Vineet and Pranav, if both of you can give your perspectives on, what do you see for this from an equity capital flow? And the second is, as you speak with investors, what do you think has been, most exciting besides your own organizations, right? And what you're looking at. But what do you think has been most attractive to folks as they come in, and for Pranav especially, into your portfolio companies? Are they really most excited about continuing to back microfinance, or is it, BNPL that we were talking about before, or is it insurtech? What's the most exciting sector now? So Vineet, maybe you can go first, and then we'll switch it to Pranav.
Sure. I think the flow of equity capital is here to stay. I think the extent of opportunity that India offers is unprecedented. And I won't even go into relative value vis-a-vis China, which is having its own challenges. I think that's one reason, but that's more short term. Then that can correct very quickly also as well. But more about the long-term opportunity that India offers. I think we see it because we see at least people in my age group, for example, relocating back from the valley or from the US East Coast back to India, right? And I've not seen that happen for the last 10 years. So there's clearly something that's working well here. The right from the government machinery to the regulatory machinery to the rise of core tech and not just services but products related tech, to scalable distribution models, and also most importantly, a learning process, right? What does it take for a company to be unit economics positive, right? And what will it take to get there, right? I think we had very, very different ideas. Let's say when Paytm started or Flipkart started, and all of us have gone through sobering realizations of what it will take, but that has not reduced the enthusiasm or the potential growth opportunity that lies even from today. So the short answer is that I think India has given very, very good returns to equity investors, and I think and especially on financial services, and financial services in India is all about inclusion. It's all about bringing payment solutions, remittance solutions, accounting solutions, using GST to bring small entrepreneurs to credit markets, delivering credit very, very efficiently, delivering credit at the last mile, making the entire process flow digital, building credit history, etc., etc. So I think so there is no escaping this market. I think global capital is very much here to stay. But I would love to hear what Pranav has to say as well.
No, I think Vineet, you and Richa in her opening note covered a lot of what I would also say, but maybe just putting it in my words. I'll make 4 points. The first 3 are, I would say, a little bit more generic than just what's happening around in the world, including India. And the fourth, I'll make India specific, because I do have visibility into many other countries where also we are investing. So just like to like. So first 3 is really demand, supply, and business environment. On the demand side, we all know this. Like, large country, underpenetrated. But just one data point. Because of Jan Dhan, I think very high percentage of households do have a bank account now. But in the last World Bank Findex, which is 4 years ago, so this number may have moved. But percentage of adults who borrowed from a formal financial institution in India was still 7%. And if you go to life insurance and other asset classes, the under penetration has not played out. Yes, it is. Penetration is improving, but we are still, in the penetration S curves. We are still, I would say, on the lower end of the S curves. So demand we all know is there. On supply, the most interesting things have happened, right? So in terms of product and distribution was your earlier question, Richa. We discussed some of that. On product, all this embedded finance and all the things you can do on a smartphone that customer has when the smartphone penetration is very high. That's all supply side innovation. Similarly, on underwriting, all the alternative data and advanced algorithms, credit bureau sophistication, which has increased. All those innovations are also in play. Just as an example, I think in India, the data usage per subscriber has gone 40 times, is up 40 times in last 6 years. So that's fascinating. And similarly on cost to serve, right, which is the other important part of the economics, all the paperless and contactless and cloud-based backend, AWS and predictive analytics to lower cost, they do make a difference compared to branch-based solution. So you got demand, which is very compelling. You got supply side, which is very compelling. And then there's the supportive business and regulatory environment where capital markets have deepened. Vineet talked about increasing track record of exits. And Richa, you talked about the regulatory tailwinds, the UPI and JAM, etc. So all these demand, supply, market environment trends are there, which bode well. But I did want to make one last point very specific to India compared to some of the other developing countries, especially smaller developing countries. It's the size and just the broader stable macro and political environment. It may not always feel so if somebody is a lot on Twitter, but it is very, very, very solid. But the size itself has enormous second order consequences. So what size does is, firstly, at a talent level, our talent pool of high quality talent, both at entrepreneur level and then later at a function level, digital level, is just there is an order of magnitude difference in quantity just because we are large, right? But ultimately, for building businesses, you don't need actually like that billion people, right? You need that layer, which India is quite blessed with because of our size and other institutions. And there is a little bit of self-perpetuating loop, right? Because if a lot of people work in companies like Flipkart, later on they become entrepreneurs in other digital companies, and there's this virtuous cycle. But size also has enormous implication on business model and unit economics, right? Because if you're big, then small niches can also be profitable, which is almost impossible if you're smallish. And then size has enormous implication on capital market depth, because if you have deep capital markets, and Vineet is the absolute bigger expert on this, but deeper capital market attract both equity and debt capital. On the equity side, I mean, it's for example, in India, I can take deals to my IC and say IPO is my exit case. I cannot do that very easily in deals in many other countries. I mean, I can say it, but they will not believe it because it's not very easy. Those markets may not have liquidity, and you may not be able to exit there. And doing strategic exits is also not very easy, including in India. So that depth of capital market is partly a function of size. And function of talent and function of demand and so on and so forth. So there is we have this great mix, which needed a few things to come in place to take us to a steeper trajectory. I think even 10 or 15 years ago, India had a trajectory, and we were growing, and we are growing, and so on and so forth. But a lot of things do seem to have come together, right, for the explosion that we are all seeing right now. But as with nature of things, then there's always sometimes more excitement than is warranted, and some things will go wrong, and there will be some course correction. But what we cannot probably disagree is the trajectory. which looks in based on the four factors I was talking about, has some real tailwinds.
Couldn't agree more, Pranav. I mean, there's been a step change, right, which has happened, and there's been a compounding effect to that. I think we're at a different trajectory than we would have even expected the country to be on a few years ago, and perhaps that's led to a lot of the bullishness that's in the market today. Has this bullishness also led to the, question that's always asked, to a valuation bubble, right? And I'd love to get everyone's thoughts here because we see founders raising capital over and over again, and given investment banking has been the core business of Unitas, I'm not going to get into how we have sort of driven that a little bit, but there's just so much capital in the market that we're seeing founders as well as investors today actually advise companies that let's raise capital while we can, right? While the markets are, excited, interested in the segment that you're in today within inclusive finance, let's raise as much capital as we can and as at the highest price as you could. Do you feel this is a bubble, and is this something that's going to burst on all of our faces very soon? Or are we all hopeful that, this is something that will perhaps self-correct over the next few years? So Pranav, we'll start with you being the, sort of most invested in this space in some ways.
Yeah, I also wear two hats, right? So while I do, I'm a buyer. I'm also a seller. I mean, I have portfolio companies, so therefore I do like high valuations as well, depending whether you're a buyer or seller. I think a couple of thoughts, especially for this audience, right? I think in the market there is a little bit of distinction right now, and this is a short-term point between let's say digital and traditional, as well as a little bit between credit, especially those that got impacted significantly in COVID-19, unsecured credit, for example, or some parts of the SME credit, for example. Versus digital, in which credit is really a promise. Maybe it's in the future, so they didn't really get impacted in the COVID-19. So it's very interesting. So while it may look like a lot of exuberance in parts of the market, it is not probably true. And Richa, you have a lot of data on this, right? That exuberance exists in all parts of the market. So Indian market, including on the public side, and of course it has gone up and up and up since COVID, which is very nice, and which also have other capital flow reasons, SIP reasons, etc. But the market is discerning, and market is discerning. So it's probably not true that it is excited about everything. However, it is probably true that market is very excited about some things, and the way some of this works is, right, the marginal buyer sets the price, which is true for both public and private market. So some of the space is truly disrupted, and everybody is trying to figure out. Founders are figuring out how best to navigate it. Funds are figuring out how best to navigate it, because there is a big difference across funds. My fund, for example, is a more PE style fund. VC funds with growth style, and they're disruptive. So people have different strategies. So I think we are going through that very interesting period in which on the capital market side and valuation side, things are going through a period, and I think it will stabilize into equilibrium sooner rather than later. But the underlying forces are there, right? Valuation is something which can swing up. Maybe one last point I'll make, right? So in the US, for example, and some of this is very global in nature. So we all know, Fed is tightening, etc. So let's see how that impacts things. In the growth companies in US, after very, very heavy run, they have corrected very meaningfully in this year, in 2021, year to date. compared to S&P or indexes, right? Very meaningfully, you're talking 40, 50, 60%, including financial services and fintech. Similarly, in BNPL, Australia has a lot of major BNPL companies, and again, there's a little bit of a reckoning. So none of this is really changes the story we have been discussing in this call. So valuation is something which can just oscillate one way or the other. Similarly, on the other side, I feel there is too much pessimism with parts of the market, including microfinance, and which will also correct towards the mean and maybe go beyond the mean as they all recover their earnings, and they will recover their earnings, at least based on the visibility I have in my own portfolio companies.
Thanks for that, Pranav. And I was just going to go to Gaurav on microfinance, which used to be the darling of inclusive finance several years ago, and seemed to move away from that, right? As you had, for lack of a better term, sexier models that just came up, right? Using technology in disrupting ways in which we didn't imagine. How do you feel having been in this space for so long, and what are you seeing as interest from capital providers across the board into this space now, and how do you see that evolving?
Yeah, so I mean, as Pranav mentioned, there seems to be a bit of pessimism towards microfinance institutions. So I mean, we have seen very few deals. I mean, if you look at 2020 and 2021, out of the total equity flow, I think less than 15% has actually come into the microfinance space. I'm talking about only about financial services. I mean, you already have the data for that, and if you count the number of deals, there are probably less than 10 deals that have happened. Equity investments in NBFC MFI. So even valuation, I think. I mean, there have been a few transactions, but again, valuations I think are deals have happened at lower valuations than what one would expect, especially if you look at the valuations at which some other companies, new age companies, have received capital, which we don't have any experience actually in lending. So as we said, there is still a lot of untapped opportunity. There are still a large number of excluded people. I think that microfinance institutions with well-established systems and processes and a branch network still are very relevant. I mean, they are. It is just a matter of time. We've been hit by one event or the other for the last 5 years, and these are significant events. So it is just a matter of time before the players come out of these problems. They are already adopting technology. Level of automation is reasonably high. Of course, as I said, to address the needs of existing customers, they have to. I mean, there's a lot more to be done. But MFIs are doing that. They are partnering with enablers, other fintechs that are enablers. So I think it's just a matter of time that the sector will start seeing inflow at better valuations. So that's what I think.
Saurabh, Vineet, do you have a contrarian view, or do you echo what Gaurav is saying here?
So coming to the equity flows, I think I'll agree with Vineet that a lot more depth is required, the debt side. But on the equity side, I think one of, and I'll come to microfinance specifically in a minute, but one of the trends we have also seen is that India remains to be a country where execution is hard, and success really depends a lot on execution. So I think promoters in some way are right in demanding an execution premium, especially if their company has been discovered and they are like in a stage Series C or a Series D of their fundraising or later, which means that they are well on their path to growth. Because the opportunities are large and there are only very few which are able to reach those stages in terms of execution. So from that point of view, we do support some level of higher valuations once a company crosses a particular threshold. But I think a lot more work has to be done on the early stages because while the incubators, accelerators, etc., which support the entrepreneur with a little bit of grant or a space or some level of expert network are there, but then there's a really large gap in the market in terms of as the entrepreneur is just moving from a seed stage. And at that point of time, we have not really seen that kind of higher valuations actually. In those stages, the valuations are still quite competitive. We also now coming back to microfinance, I think at least the general perception of the industry from an equity standpoint still is that the stronger players went on and became a small finance bank, and now what you have are the institutions which could not go on that path. So there was that perception which was driving sort of valuation a bit depressed in the market for some time, and of course the crises like have not helped either. But the opportunity is there, and if there are institutions which can keep the focus on execution and drive up, because I'm not really sure. Well, we are seeing some assisted models on microfinance, but really the core business model still remains very similar to how it has been standardized. So in that way, I think there can be a case-to-case wherein founders or entrepreneurs may be able to demand premium, but I think an across-the-board uptick might be a little difficult, at least in the current scenario. Also, given the fact that due to the COVID and recent pandemic, now the books need some time before they get stabilized. So I think for next year or two, it will be difficult sector to work with, but at the same time, maybe that will reduce the competition in the sector, and sometimes there are other positive benefits which may come out.
I think one thing I will definitely echo what Saurabh said is that the flow of capital to smaller companies has definitely been wanting. And I would actually argue that it's worsened a bit in the last 5 to 10 years. I think 5 to 10 years back, an NBFC at a 50 crore balance sheet could actually find suitors, and there were specialized players. For example, the role that Matrix has played has been phenomenal. The role that Sequoia has played has been phenomenal at a very early stage for the financial services industry. And I think as some of these firms have become larger and their check sizes have increased, there have not been as many who have filled that space, right? As for example, an Omnivore is doing very well right now in the agri-tech industry, for example, right? And as a result, I think today for a new company that is being set up, there are multiple premisses. The first is that the Reserve Bank seems to be intent on raising the barrier to entry and taking the initial capital to 20 crores. That's tough, right? And had this been true, 5 years back, perhaps Vivriti could not have started, right? The second is the fact that investors are seeking a certain minimum AUM before they would like to pay, as Saurabh said, the execution premium, so to speak, right? That number is the number we're hearing is more in the range of $25 to $50 million of scale before serious equity capital can come in. Now, in that period of time, all you can look forward to is a combination of bootstrapping, friends and family, and co-lending partnerships to be able to get to that level of scale, pay your costs, build a certain network of branches, distribution, people, technology, etc. Right? So the road has become a bit tougher for the early stage entrepreneur who does not have capital backing on day zero, right? But the road has definitely become easier once you cross that phase, because then the sheer demand supply is very different, and therefore there is more capital chasing companies that are doing well. Microfinance, unfortunately, has gone through a tough phase with a little bit of, I would say, flip-flop on regulation. Now with regulation changing, the case for small microfinance companies can get better. These are, I think, most eagerly awaited regulatory changes, right from the number of lenders a borrower might have, removing pricing caps, etc., that make this space much more sustainable. And if those come across, then I think the case for small MFIs does become better. I agree with Saurabh that that there was a perception issue on microfinance companies becoming small finance banks. It was looked positively. Now it's a bit mixed, right? I would say at best on what that experience has been like, and therefore the number of SFB applications themselves have had, it shows up very clearly, right? That the applications itself have come down. So I think in microfinance, the other challenge is that we went through a period between 2007 to 2010 when there was great progress. Then there was a huge break. Then again from 2013 to 2016, great progress. From 2016 to 2021, it's been literally one crisis after the other. And as a result, I think has equity value really multiplied the way it should have for founders in microfinance versus other parts of the financial services ecosystem? I don't think so. While the execution challenges are possibly higher, right? So these are, I think, somewhat dampeners on microfinance per se. But in general, financial services, early stage, still tough. Mid stage to late stage, much easier.
Thanks for that, Vineet. Totally agree with what both you and Saurabh said. I think even what we've seen on the ground is very, very similar. There's obviously been a lot of potential M&A activity that's come up as a result of all of this, right? Which may or may not be a good thing. So in some cases, it could result in strengthening of organizations that have struggled just because of this lack of capital, not necessarily because of lack of execution. And provide those exits that we keep talking about. But on the other hand, it can also be a dampener because there are some phenomenal founders that just struggled because of the situations they were put in more from a macro perspective. I'm just going to add in a couple of questions we've received from the audience, right? And the first one's really, do you think the pandemic will accelerate the rate of impact investment being done in India? Or will they start being more cautious? So do you think the pandemic has really made a difference in what we're seeing in the market today? And, maybe Pranav, if you want to go first on this one.
I think for the many things we discussed earlier in the call, the sentiment is probably very strong on India. I think this year 40, 45 unicorns, etc. So sentiment is very strong. India has come out of the pandemic quite well so far. And therefore, specific to the impact investment sector, my view is that the sentiment is similar. There will be additional focus on digital transformation for those who have more physical business. That emphasis will increase meaningfully, and innovative business models, because COVID really accelerated. Everyone knows this, that accelerated some of the shifts towards digital adoption for consumers, including in the emerging consumer bottom of the pyramid space, informal space. So anybody doing disruptive, also taking advantage of many of the government infrastructure, and there's so much innovation happening there, which jury's out what will be disruptive. But beyond UPI, there's stuff like Open account aggregators, there's a bunch of stuff in the pipeline, DigiLockers, etc., that has still yet to play out. So my sense is there's a lot of interest. We have to see, winners and losers.
Thanks, Pranav. You brought up the point on disruption, and maybe we can just go around the table on what's the one disruption you're most excited about, right? Either one that you've seen, in the last 12, 18 months, but one that you would really hope to see. And maybe Saurabh, we can start with you, and then Vineet, Gaurav, and Pranav.
Definitely agri-tech. Spoke a bit about it earlier, but like I said, the answer is obviously for us coming more from the real side of the economy, but as the impact is becoming more widestream, what we are seeing the young professionals going and starting startups in the sectors which earlier were really difficult, right? I mean, around 2000, when the microfinance institutions got started, then at that time, Samit or Vasu or Ramesh from the small finance banks were like some of the early bankers who started the microfinance, and we are now industry in a formal way. And now we are seeing something similar in the other sectors. So definitely very interested and looking forward to look at agri-tech more seriously.
Gaurav?
Yeah, I mean, there is so many innovations happening that it's very difficult to pinpoint one single most exciting one. But staying with microfinance, as I said, the good thing about microfinance institutions is that they have access to a lot of data. I mean, be it text, be it voice, be it images, be it spatial data, and it all comes with consent, customer consent. So what I would like to see is how MFIs build their AI engines to process all this unstructured data and make it an integral part of their routine operations. Be it client acquisition, underwriting, risk management, and even employee management, which is extremely important. And I think that would be the difference between MFIs that kind of grow and those that stagnate. I think that'll be the difference. That'll be the key differentiator.
Go ahead, Vinny.
I think we've seen a lot of work that that the financial services space has put in towards innovation the last several years. I think a few examples that strike out. We saw a company that was using photographs and aerial photographs of clusters of houses to really determine whether borrowers actually live next to each other, and using that to determine group structure, right? Very useful and definitely thought-provoking, because it seemed to me over the last several years that the structure of the group has really weakened in microfinance, right? We've seen companies that are building payment solutions at the farmer level. We just reviewed a company that's now doing this in farms in MP, Chhattisgarh, Maharashtra, as well as South, and using that to link them to formal financial services. Again, not something that's been done at scale, and this is especially on the dairy side, right? We are seeing companies that are devoting a lot of time to understanding credit behavior. I echo what Gaurav said about the fact that microfinance companies do have a lot of data, but do not necessarily use it efficiently enough. The next 5 years should change that. We are seeing a lot of microfinance companies now changing their ambition from being group lenders to individual lenders. I think data will play a very, very significant role in that transition. We are also seeing that companies are playing a role in trying to map household indebtedness, something that's been my own personal passion, but I must confess I've not gotten anywhere with it, right? But today there's a significant convergence of the borrower base between gold loan, two-wheeler, microfinance, and unsecured consumer, especially on consumer durable finance, right? But the default rates are very, very different, right? And very, very few companies have actually had build the ability to cross sell. It's been a myth that cross-selling is possible at scale and profitably in these segments. Many have tried, not necessarily succeeded. For example, gold loan companies acquired microfinance companies with the objective of building a cross-selling product. It's not scaled. It's been several years, but not really scaled to the extent that it could have potentially, right? So I think there's a lot left to happen on innovation in financial services, and very, very interesting last mile innovation that's happening as we speak.
For me, I think I'm most excited about founders and talent. A slightly oblique answer, but and who are empowered much more than in the past. By that, what I mean is, we always had a lot of smart people, but now we have folks who got the training with a lot of success stories. We have so many financial services success stories who are now listed companies, started from scratch. I think some folks in this panel have worked with them in that journey. And similarly on the digital side, so many success stories now, which is the training ground for this new generation of founders. So that's one empowerment training. Second is this signal effect of seeing success firsthand, seeing wealth creation, etc. firsthand, that this is for real. And when we all were studying, if some of us maybe from small towns, and there will be a few kids from the school who did IAS or something else, and it inspires the next set of kids, right? That they can also do something, even if they are from small town places. It's a bit like that, right? I mean, India, end of the day, is still a poor country, but there's so many of people's peers have been able to do that. So that is itself is quite powerful. And then the whole ecosystem, and there's a technology in general, but then the very specific things that are in place today, right? That people didn't have 5 or 10 years ago, whether they jam, UPI, people mobility, and all. AWS, for example, by the way, variable cost, very helpful. All that empowerment it's not that things are not challenging. At some level, things are very challenging because there are many such founders. Competition is intense, and the big incumbents will fight back, and you have to figure it out, and business models pivot more than in the past, and it's all very difficult still. But it is also they are also empowered. All these very smart and very driven and visionary people are empowered in a way which is just very different from before. That's very exciting, and I think we will all see the result of that energy. Some of those folks are on this panel, so we will all definitely see the results of that drive, energy, and vision in coming years.
Thanks, Pranav, and thanks all of you. I know we're almost at time, but I'll try to quickly summarize, I think, what we've learned from this very engaging panel today. Right? Founder/talent is paramount, right? I think we all look for, those unique individuals that are really going out to create those disruptive solutions to problems. India is a large market. I think we all agree, and that's here to stay, and it's only growing. Technology has helped disrupt it in many ways, but has also performed and created those building blocks for us to build off of. The many pools of capital, and that's an encouraging thing, I think, for the audience to take away, that's available today, right? What started as grants and guarantees is now debt and equity. Well, debt is still exotic, as Vineet was telling us a little while ago. Certainly, the equity floodgates have opened to some extent, and founders are taking advantage of that as best as possible. But there has been a shift, right? So there has been a shift of capital. As much as Gaurav probably wouldn't like me saying this, microfinance is where it all started, and maybe it's a virtuous cycle, and we'll come back to that eventually. But a lot of the capital has moved into other parts of inclusive finance today, and certain other sectors are perhaps more interesting and exciting to investors. Be it fintech, be it insurtech, be it other forms of embedded credit and the platform-based approaches that we were talking about. But at the end of the day, what's still most important to companies in the inclusive finance space, we know distribution is hard, but is paramount. Credit discipline is key. Execution is difficult, but that's really what's going to make you stand out. And, the word that was never used before, but has been used more than I've ever heard in the last 18 months is unit economics. That's still paramount. And I think the focus on unit economics is really what's here to stay. And everyone on this panel has stressed on that in many, many different ways. We can all debate and argue whether new to credit exists or doesn't. I think we've heard the contrarian views from the panel here today. But I think what's definitely something we should all take away from is the market for credit is here and it's only growing. And we're all excited to see where this journey takes us. So with that, I'll turn it back over to Priyank to wrap the session up. But thank you everyone on the panel for all your insightful comments.
Thank you everyone for such a thought-provoking discussion, and special thanks to Richa in particular for such deft moderation. I would also like to thank all the delegates who have logged in for this session. So now we'll take just a 5-minute break and we'll join again at 2:05 for an important session on impact investing landscape beyond the lending models. Thank you all.